Hey everyone, UpStart stock was soaring over 30% after the company reported first quarter earnings results. So, what happened in that quarter that sent the stock soaring? That's what I'm going to talk about in this video and kind of elaborate on what's going on with UpStart stock. So, revenue decreased by 67% in the quarter to 103 million compared to the same quarter last year. Upstart reported a $132 million loss from operations compared to an operating income of 35 million in the same quarter last year. So given those two metrics, you might ask yourself, really? After that kind of performance, the stock was up by more than 30%? Yes, and I'll tell you why. So stay tuned for a little bit longer here. Management, I think, made a good move here in slashing the sales and marketing budget from 133.4 million in the same quarter last year down to just 31.4 million in the current quarter. That was smart, I thought. But here is why the stock was soaring over 30%, and I've pulled this quote directly from the company's press release here. Despite the headwinds facing our industry, and this is the CEO talking, we secured multiple long-term funding agreements together expected to deliver more than $2 billion to the Upstart platform over the next 12 months. That's what sent the stock soaring, that the company was able to secure funding for loans on the platform. And that helps Upstart's business model, right? If you're not aware, Upstart is a platform that brings together lenders and borrowers in essence, and that's what Upstart wants to do. Just bring together borrowers and lenders and take a fee off of each loan that they help originate in that process. Upstart does not want to be the one that's funding these loans. They don't want to be a lender. They want to be the platform that brings together borrowers and lenders. There's a big difference there because if you're the lender, you're taking on more risk and the rate of return is not as high. The return on investment, the profit margin is not as high when you're a lender versus when you're just bringing together a borrower and lender and then you're taking fees off of each transaction that happens on your platform. That's a much more lucrative source of revenue, a much more profitable source of revenue, and a much lower risk profile in revenue. So, in the last few quarters, Upstart has been forced, well, not forced, but they've chosen to fund some of the loans on the platform because there wasn't outside funding. The outside funders, investors, pulled back and paused lending on the platform because of fears of an oncoming economic recession. Since Upstart is a relatively new funding platform, their loans haven't gone through an economic cycle to show what the losses are going to be. How many people are going to default on the loans that were originated on the Upstart platform if the economy goes into a recession? Defaults on loans always go up during economic recessions. So investors are already expecting an increase in defaults. But to add another layer of risk, Upstart is a new funding platform without the long history of economic cycles, so investors can more accurately know what those losses are going to be. So for that reason and the several other reasons, investors stopped or paused or significantly reduced lending on the platform, and Upstart chose to step in to fill that gap. They now have $1 billion, well, $982 million of loans at fair value on their balance sheet as a result. That's not the business they want to be in. So this was great news that they were able to secure $2 billion on the Upstart platform over the next 12 months. This is going to help Upstart get back into the business they want to be in, which is just bringing together borrowers and lenders and pulling itself away from the business of being the lender itself. Still, this is just a deal, an announcement. This has yet to come to fruition in the company's financials, in the company's lending figures and funding figures. So Yes, investors have a reasonable cause to get excited about this announcement, although it's important not to get too excited about this announcement, right? Let's take it where it is and not get ahead of ourselves and think, okay, Upstart is going to turn things around immediately and things are going to improve. We don't know that yet. Okay, so yes, they're likely to improve, but let's wait until those figures start to come out. Because let's keep going. Look at lending partners originated 84,000 loans totaling 997 million in this first quarter. That was down 78% year over year. So there's still significant struggles on Upstart. The conversion on rate request was just 8% in the first quarter. That was down from 21% in the first quarter of 2022. So across the board, you could look at all of these metrics on the Upstart platform, and year over year, you can see things worsening, and significantly so. This news was very good for investors. Let's hope that it shows up in their financials, in their loans, in their revenue, and starts to improve Upstart's profit prospects and lending prospects. All right, that's all I've got on this video. I hope that shed some light on what's going on with Upstart stock, a very exciting artificial intelligence lending platform. All right, thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.